So the question is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or a couple of things. Number one, I would increase my allocation to cash. I'll stick with cash, but let me kind of put that in a context. The most powerful investment tool we have is diversification. Problem is people don't understand what diversification means. So I run into people all the time.
In the interview, Jim Rickards discusses the potential actions of the Federal Reserve to control inflation, possibly leading to a severe recession and stock market crash. He advises diversifying investments beyond stocks, suggesting a 10% allocation to gold and a significant 30% in cash to reduce overall portfolio risk. Rickards highlights the value of cash during deflationary periods and its usefulness for seizing buying opportunities during market downturns. He points out limitations in renewable energy and suggests investing in the oil sector due to its indispensability. Rickards recommends a diversified portfolio comprising energy stocks, private equity, real estate, farmland, and gold. He believes the Fed's reliance on flawed economic models might hinder their ability to foresee potential risks accurately, with market participants likely noticing these risks before the Fed does.
They say, well, I'm completely diversified. I own 50 different stocks in 10 different sectors, semiconductors, consumer non-durables, minerals, et cetera. And I say, you're not diversified. You may own 50 stocks in 10 sectors, but you have one asset class, stocks, which are subject to conditional correlation. In calm markets, they're idiosyncratic, but in panics, they all go down together, or in bubbles, they all go up together. So you're not diversified. So what is diversification? Is having slices of asset class that are minimally correlated. It's probably not zero, but as close to zero as you can get. So what would that be? You'd have a slice of gold, but I recommend 10%. And people, some strong view of gold, and I've written a lot about it, but people are surprised to hear me say 10%. Like, oh, Jim, why isn't it 50% or 100% if you believe all this? Well, I do believe it. I wouldn't say it if I didn't, but you don't want to be 100% in anything. You don't want to be 50%. 10% is fine. If I'm wrong, you won't get hurt. And if I'm right, you're going to make so much money that it'll actually kind of be the insurance on the rest of your portfolio. But that leaves 90%. So I would have a large slug in cash, maybe 30%. And people say, well, wait a second. Banks pay me 25 basis points, stock market going up. Why would I want to be in cash? That's horrible. A couple of things. Number one, the stock market might not always go up. Cash is the opposite. So leverage increases the volatility of the rest of the portfolio. You'll get much bigger returns, but you'll have much bigger. If you have a slice of cash and you've got a volatile asset over here, which are stocks and other volatile, your gold is fairly volatile. If you got that volatility and you have cash, it will reduce the overall volatility so you can sleep better. Cash is a great asset in deflation. And if you're talking about inflation, which is here, then you got to deal with that. But don't rule out deflation. If we go into a recession because the Fed over tightens, or, the thing about the inflation, just a quick side, it comes in two flavors. There's cost push and demand pull. Demand pull is when individuals are worried about inflation and they start accelerating purchases, like, hey, I better go buy that washing machine right now because the price is going up, or better go buy that house right now because the price is going up. That's demand pull. Cost push comes from the supply side, demand side. And that's what we're seeing because of what we talked about, supply chain, energy cost. The Fed can't drill for oil. Raising interest rates doesn't get you more oil or natural gas. So the Fed can't do anything about it except kill the economy. Yeah, and that'll cool it off. But when you pay, I put gas in my car. I don't just read about this stuff. It used to be $45. Now it's about $75. Multiply that by 200 million cars across America. What happens is it reduces your discretionary income. If you're paying another $30 at the pump twice a week, then you're not going to go out to dinner Friday night. You're not going to, take a vacation, whatever it may be. So that depresses all those other areas. So there is this recursive function. So don't rule out deflation down the road, not right away. Here, so cash. But here's the biggest value of cash. It gives you optionality. People don't understand this. What if I said to you, hey, I'll sell you a call option, an at the market call option on every asset class? You go, gee, that sounds kind of valuable. Well, that's what cash is. When things are crashing, you're the one who can go shopping, and nobody's better at this than Warren Buffett. He's got his cash level at Berkshire Hathaway high. So there's a place for that. You can have some stocks, but I would look at the energy sector. I mean, I actually built and I own the largest non-commercial solar module field, and I run my house off. It produces about 7.5 kilowatt hours. So I know a little bit about it. And what I know is it doesn't work at night. It doesn't work in snow. It doesn't work in rain. It doesn't work in really cloudy days. By the way, you don't run your house off of solar modules. You run your house off,
Yeah.
and then the modules charge the battery. So you watch the battery. That's how you manage. So it works fine. But if you think you can run cities with it, forget it. So it's just not practical at that scale. Even if you thought it was, and it isn't. That's there. But here comes, wind turbines and solar. And I'm not against it. Like I say, I own one. But they're not scalable. They're intermittent. And they don't give you the baseline power you need to run a modern power grid. Meanwhile, here's global demand. Okay, so the gap's getting bigger. It's not getting smaller. Renewables, whatever the pros and cons, are not closing the gap. The gap's getting bigger. There is no substitute for oil and natural gas and uranium. You mix and hydro. If you look back, that's great. Not so much in the desert. And I've spoken to, without mentioning names, I would say you can go no higher in terms of those. Let's just say board 5 biggest oil companies in the world who said, yeah, as he said, we talk about that, but we can't say it publicly. Chained and dragged through the streets. But those are just the facts. So therefore, if you have an oil sector that's been bashed by the climate alarmists and you can't do without it, which is true, buy some oil companies. So there's your stock portfolio. Private equity, venture, real estate, not commercial, but residential, yes. And farmland, that's one of the hottest asset categories, and gold. So that's diversification, and that's the kind of portfolio, kind of season. So the question is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or will they see that coming? And they'll be the last to know. We'll all see it before they'll be the last to know. It's because they rely on flood models and they're kind of in their own.
In a nutshell, Jim Rickards reflects on the Federal Reserve's handling of the economy, noting its slow response and potential consequences. He compares current events to past patterns from 2013 to 2020, highlighting the Fed's attempts to normalize interest rates and reduce the balance sheet, which ultimately led to market volatility and subsequent policy reversals. Rickards describes a cyclic pattern of tapering asset purchases, rate hikes, market declines, rate cuts, and resumption of quantitative easing. He points out the Fed's recent rate hike in March, predicting another increase in May, emphasizing the predictability of their actions based on their transparent communication, and suggests this pattern may lead to a similar outcome as seen in the past.
Economic forecasting bubble, very defective thinking about the economy. They're very much a creature of inertia. There are a whole lot of reasons why the Fed is not nimble. It's kind of quite the opposite. But they'll see it eventually, probably when it's too late. And will they balk at that point and stop rate hikes and maybe even reduce rates? That could save us from the recession, but that will just amplify the issue. So rather than say which one's going to happen, I prefer to lay out those two paths and then just watch it very carefully. But more to the point, we've seen this movie before. This is a replay, and I think it's on, like you hit the remote control for double or triple speed. It's going to happen faster. But this is a replay of everything that happened from 2013 to 2019 and into 2020, which was, I'll just go through it quickly. So 2013, May, Bernanke says we're going to taper asset purchases. That's money printing, quantitative easing, whatever. The market, tanks, bonds go down. Everyone's like, oh, it's over. Bernanke balked. But finally, in November 2013, they said, okay, the taper begins. They were still printing money, but at a slower rate, and that mattered. That went on until late 2014. The taper was over. They stopped buying new assets. They said, okay, here come the interest rate hikes. Except they didn't come for another year. It wasn't until December 2015 that then Janet Yellen finally raised rates. And then another year for the second rate increase. So it was December 2016. So it was really, really slow. Took 2.5 years, but they got to 2 rate hikes. But then here comes Jay Powell. And then like clockwork, boom, 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 25 basis point hikes every meeting. And all the Fed was trying to do was to get back to normal. They were trying to get interest rates to maybe 2.25, 2.5, get the balance sheet down to, something like 2.5 trillion. They never specified. Okay, now interest rates are kind of normal, 2.5. Balance sheet's down around 2.5 trillion. We're back to normal. We finally got through the global financial crisis of 2008. We undid all that stuff. Well, what happened? From October 1st, 2018 to December 24th, 2000, the stock market dropped 20%. That was the December 24th, 2018, we call it the Christmas Eve massacre. Stock market went down 3% in one day. But the Fed was tightening into the weakness, as they always do. And the last interest rate hike, it was December 16th or 17th, within a day or two, but mid-December 2018, they were still hiking and raising rates. And that was the last straw. And then the market just tanked. And then finally, Jay Powell got the message First week of January 2019, he says, okay, that's it. We're going to be patient. Use the word patient. It's one of these code words. You have to get the code book out and see what it means. But patient means we won't raise rates again without giving you advance warning so you can get out of your. And then he went further, said, looks like we got to cut rates. And they did. And then by early 2020, here comes the pandemic. And then they took rates all the way back to zero. And then they started QE, I don't know, 6, 7, call it what you want. They took the balance sheet to $7.5 trillion after getting it down. So look at that whole sequence from 2013 to early 2020, including the pandemic. What happened? They tapered the asset purchase. They raised rates. They sank the stock market. Then they said, okay, no more rate hikes. Then they cut rates. And then they started QE. And by April 2020, where were we? Zero rates, back down to zero, and the balance sheet was $7.5 trillion, down to about $3.5 trillion. So that was a big circle. They ended up back where they started from. The point being, they failed to normalize. They failed to get rates where they failed to get the balance sheet where they did sink the stock market. Okay. Now, 2 years forward, here we are again. What are we doing? They just raised rates at the March meeting. They're going to raise them again in May, and that's the easiest forecast I've ever made. 2 basis points, May 4th. You can count on it. And they're going to announce. By the way, I don't have a crystal ball. The Fed told us this. I mean, that's the thing about the Fed. They may be wrong, but they're transparently wrong. So they tell you what mistakes they can advance. So that's the Fed forecasting is actually fairly straightforward because you just have to believe them. So they're going to raise rates again.